What is up, everybody? This is the second edition of today's VA Loan Lunch and Learn. Small snafu as far as recording goes on the live version, but I did want to get the content up on YouTube. So we are recording and we are going to get right into it, y'all. So let me share my screen and we'll get to the slides. Again, this is the VA Loan Virtual Lunch and Learn. We do this every other Thursday, and the idea is just to have better conversations regarding the VA loan. And we take 30 minutes out of our every other Thursday to do so. So again, the purpose of this call is education only. I am not a certified loan originator, nor am I a certified tax professional. We're going to get into something. We're going to get into a little bit of both. If you have any personal financing questions as far as homes go, or personal tax questions, please reach out to a certified professional. This is also not a request for business or solicitation for business. And if I see any professionals in the call doing so, and happens to be a VA buyer perhaps in the call, you will be asked to leave. And if you do it again, you will be banned from the calls. Again, the QR code at the bottom is the VA Loan Handbook. And we're going to talk about a lot of things throughout these calls, but in the end, always verify everything with that handbook. And again, we always say the handbook's very black and white, but the VA loan oftentimes operates in the gray, which is a good thing. So I always start our calls off with this. The purpose of the VA loan, while not official, is to give every man and woman that serve this country the lowest barrier entry possible to owning a piece of it. Now, why do I say lowest barrier to entry? Well, because that's a very important word when it comes to home ownership. There are a lot of barriers to entry when it comes to owning a home. Number one being the down payment. Well, the VA loan is a zero down loan. They can put a down payment on it if they want, but for the most part, it's zero down. Number two, another barrier to entry is credit, debt to income ratios. Well, guess what? There definitely is no credit, minimum credit score with the VA loan. There are lender overlays, but theoretically, there's no minimum credit score. And the VA loan has one of the most buyer-friendly debt to income ratios when it comes to approving somebody. In fact, they really don't even go by debt to income. They go by what's called residual income, but that's a concept for another call. And thirdly, monthly payment can oftentimes, especially in a high interest rate environment, can oftentimes be a very big barrier to entry for home ownership. Well, if you sit side by side, you put an FHA loan next to a VA loan, same property, same person, same credit score, you name it, the VA loan is still going to be a lower monthly payment than the 3.5% down FHA because the VA loan does not require primary mortgage insurance. So that's a huge, huge, huge relief for a veteran home buyer or active duty home buyer. So nationwide statistics say that between 13 and 33% of the veteran community use their VA loan. Now, this in and of itself is a pretty terrible statistic. This is due to several reasons. Number one, there's a very underwhelming separation process when a person going on active duty gets out and becomes a veteran and transitions to civilian life. But number two, there's just not enough conversations happening in the real estate space or the veteran space. I'm a veteran. We need to get better at having these conversations. And of the 67% that don't use it, half don't even know it exists. Now, that's pretty bad as well. That means that 33% or so of veterans do not even know they have a VA loan. And I've come across several that don't even understand what it is. And of the other half that don't intend to use it, and the reason why they don't intend to use it is because they were given bad information by the real estate professional community. So again, we're not trying to blame anybody here. We're not playing the blame game. The reason for conversations like this and calls like this is because we need to change these stats. And so the best way of doing that is just to have better conversations. So today's topic, we're going to talk about appraisal disputes and starting a zero down business using your VA home loan. So let's talk about appraisals. So it's a very big stigma out there that, oh no, the appraisal is not going to come in at value, or oh no, the appraiser is not going to appraise because the floor is not perfect. Well, listen, the way the VA appraisal process works is it's actually very similar to every other appraisal process. The only thing that's different is number one, the appraiser is assigned by the regional loan center. Number two, they are certified under the VA. And number three, they have to make sure that the property is safe, structurally sound, and sanitary. So basically, everything that would fall under those three S's is anything that you would also need to have through an FHA loan as well. So to say that an FHA appraiser is more likely to meet value than VA is just incorrect. And again, they're the same appraiser as any other appraiser, whether it be doing conventional appraiser or FHA or VA. They're all the same. They just have a little bit more designation. They're looking at one or two different things. And in the end, the VA appraisal process has a reason behind it. It's to protect the VA buyer and make sure they're not buying a property that's in really, really bad condition or paying too much for a property. Those are both good things. And however, sometimes that appraisal will come back a little low. Now, I don't know the nationwide statistics on this, but I'd be willing to bet if you looked up the amount of times that a conventional appraisal doesn't meet value versus a VA appraisal, it's probably very similar. And I would even say that the VA appraisal process probably meets value more oftentimes than the conventional because of the two things we're going to talk about today, which give the VA buyer and their team, a way of disputing an appraisal coming in low. So first and foremost, we'll talk about this on another call, but let's say that an appraisal comes back subject to a repair requirement. Well, the VA handbook actually has a process where as long as the property is still safe, sanitary, and structurally sound, they can waive that repair. And what that usually looks like is just something small like a floor is not level in a room. Well, the veteran still wants to buy the home. They can fix it later. So they can basically waive that repair. But we're going to get into value, not meeting value. So there's three remedies that the VA buyer has if the appraisal does not meet value. And number one, which should honestly be number three, I just put it on there. Buyer and seller can renegotiate the contract price, which I think should be the last thing that you do, because the first two things you should do is go through what's called tidewater and reconsideration of value, because both parties agreed to pay a certain amount and receive a certain amount for this home. We should do everything we can to make get the agreed upon contract to the finish line. So Tidewater, it's called Tidewater because it was first used in an area where it was actually called the Tidewater area. And what it does is, so if the appraiser thinks that the value is going to come in low, they will do what's called invoke Tidewater. Now, this gives all parties involved a chance to submit comparable properties that they believe show the property's value is at or above the contract price. Now, why do I highlight all parties? Because it's not just the job of the buyer's agent to show that the contract price is the correct price. It's all parties. It's the listing agent, it's the seller, it's the buyer, it's the loan officer, it's everybody involved in the transaction. Because when on the listing side, the seller side, when the listing agent decided on the listing price, you have comparable properties in mind to get you to that price. And so if this appraiser is coming back and saying that it's not at that value, you should be able to go against that with the properties that you use to deem that this is the sales price of the home. So basically, the real estate professionals team, this is your chance to combat the appraiser directly. You have 2 full business days to submit your comp. So meaning if they issue Tidewater on Thursday, you have until the following Monday at 5 o'clock. At a minimum, you should be submitting the following to the appraiser: the street address of the properties that you think are better comp, sales price, the date of sale, the gross living area, copy of the MLS sheet, and all other relevant information that can assist the appraiser in determining that the sale that you're giving them should be used as a comparable. And what that is like, I mean, if you have maybe something that, let's say there's a home with a little more square footage, down the street, but it's a similar floor plan. You can state that in your email and say, this is why I believe that this is a better comparable property than the home that you probably used, which is the same square footage. So things to consider when picking out your comps. Number one, the less adjustments, the better. So this is actually good because a lot of times the appraiser will tend to err on the side of properties that are closer in proximity. If you can find a similar property, maybe a couple neighborhoods over, that is the same floor plan. Therefore, the appraiser doesn't have to make a bunch of adjustments in order to have a comparable property. All of a sudden, you could sway that appraiser. They don't like making adjustments. It gets messy. Obviously, it's a you can make these adjustments, but you would rather have a side by side similar property that uses a comparable. Again, work as a team. This is not like the buyer's side responsibility. This is the entire real estate team involved in this transaction. And while not required, it is best practice to use what's called a tidewater grid. And why this is important is because, guys and gals, we need to be professional when we are doing anything in a real estate transaction. And one of those things is having it in a logical, flowing, data that everybody can read and agree upon. And in the end, this is the language that the appraiser speaks, essentially. So, and also in the end, you are trying to convince this appraiser that he's wrong or they are wrong. And I don't know about anybody else out there, but if you're going to tell me I'm wrong, you better tell me why in language that I understand. So take the time, find a tidewater grid, fill it out, submit it with your comparables, and all of a sudden that appraiser is going to respect the fact that you took the time to actually give him some data in a way that they actually understand it. So that's Tidewater. Now let's move on to reconsideration of value. So sometimes it works, sometimes Tidewater doesn't, right? If it doesn't, there is a second method to bring up the appraised value to the contract price. So what happens is, if the appraiser decides not to use the comparable properties that you issued, they will give their opinion to the Regional Loan Center, and the Regional Loan Center will issue what's called Notice of Value, or NOV. If this happens, there is that second way of appealing the appraised value, which is called Reconsideration of Value, or ROV. This is basically the buyer's chance to go to a staff appraiser at the Regional Loan Center and plead their case as to why the home is worth what they have agreed to pay for it. So this is a time, again, for all parties involved to go all out, using both data and circumstantial evidence as to why the property should be valued at the contract price. And so when we're doing reconsideration of value, you can actually get into, we'll get in on the next slide, things that don't show up on an appraisal. What do I mean by that? Well, this buyer potentially has been looking for 6 months and they finally found the right property. That means they spent a lot of time finding this home. That weighs in on reconsideration value. It just simply does not for Tidewater. It's very important that everything is done professionally. And when I say that, I mean professionally and with precision. You need to have everything submitted in one packet and broken down in the way that this staff appraiser at the Regional Loan Center will understand. And I will get into it on the next slide about what that actually means. But here's what you want to include in this Tidewater packet. Number one, reconsideration of value packet. Number one, everything that you submitted for Tidewater, and that includes the grid and MLS sheet and your basic explanation of why you think the comps are superior. But in addition to that, maybe some new data that can be better explained to somebody that is not the appraiser. What does that mean? Well, I mean, if the subject property has additional square footage that's not necessarily heated and cooled, but it has maybe like a mini split, you can argue that that will add value to the property. What the appraiser didn't use that as actual square footage to add value. So you can include anything like that. Very important, you include a letter from the VA loan buyer to the Regional Loan Center. And we'll get into what that needs to look like later. And then anything else that could sway an opinion. What does that mean? Well, let's say you are the buyer's representative. You know how many houses you've taken this person to. You know how long they've been looking. You know their situation. So you should be writing a letter as well to the Regional Loan Center telling all these things and giving your opinion and signing it. And even maybe the loan officer can write a letter. The more the better, you know. But again, make sure it's broken down very, very professionally and very, very precisely. So things that you're going to include in all correspondences to the regional loan center, and every letter. Why the buyer thinks the submitted comps are better. So if you are the buyer's representative, you're going to say why you think the comps you submitted are better, and the letter from the buyer is going to be from the buyer's perspective. You're going to include the time, effort, and money the buyer has already spent. And what does that look like? I mean, you're going to point out the fact that they have, at this point, paid for an inspection, a wood destroying insect inspection, potentially an HVAC inspection, and an appraisal. So they could be out of pocket close to $1,500, and if this deal doesn't go through, they lose that. So that's something that the regional loan center will consider, but the appraiser won't. Another thing to consider is that you want to add in the letter that they've looked for however many months and they finally found the house. There's no other house that fits the needs that they like. Concessions are a big thing, especially in a high interest rate environment. The buyer needs to convey to this regional loan center that we can't afford this house without the concessions that are included because we are paying this much for the home. And again, the letter needs to be signed. Oh yeah, also include any hardship information that the veteran wants to include. Meaning, let's say they're in a wheelchair and the doorway is finally wide enough for them to access every room in the house. That is definitely something to include to help with the reconsideration of value. Again, sign every letter by whoever is writing it, whether it be from the buyer's representative. It can even come from the seller. You can have a seller sign a letter saying how much they want this home to go to this new buyer, but they have to walk away with a certain amount of money because they're buying another home. You can include all of that, but just make sure it's signed by whoever's writing it. And remember, the last part there, make sure we are breaking down everything Barney style. What does that mean? It needs to be sent to a 8-year-old pretty much. That's the term that we use in the military, and it basically just means that. Explain it to me like I'm an 8-year-old. Every correspondence, every letter needs to have that in mind, because in the end, what you're doing is you're trying to convince a bureaucrat that the system that they have full faith in is actually incorrect, and it gave a wrong outcome this time. So again, make sure everything is dumbed down, lowest common denominator understandability here. Just keep that in mind when you're writing these letters. And in fact, use AI. I've had several of these ROV letters written by ChatGPT, and they are phenomenal. So definitely leverage that. The good news is, if done correctly nationwide, there is an 87% success rate in bringing the appraised value of the home to the contract price. And that's just something that's unheard of in the FHA and conventional loan community. There is no method if an FHA appraisal comes back low that they have an 87% success rate in bringing the appraised value to the contract price. Now think about that. And on the real estate professional side, when you are considering offers for your seller, if you're looking at an FHA and a VA offer, does the FHA offer have an 87 or have a mechanism to bring the appraised value to the contract price at a success rate of 87%? It does not. Therefore, that VA offer is superior. Make sure we are not, I don't want to say discriminate, but make sure we are not telling people that the VA loan offer is inferior because of the appraisal. We actually have a very solid chance of it meeting value. All right, we'll skip that slide since nobody's on. And we are going to get into the next portion of the call. So this is the tactical version, or the tactical portion of the call. The first part was about the technicalities of Tidewater and reconsideration of value. Now I want to kind of get into a really super fun concept that veterans can use, or even active duty can use. In this instance, we're going to be talking about a veteran. And what that is two entrepreneurially minded veterans. It doesn't have to be two in this situation, it just makes sense. Partnering together using their eligibility and what their qualifying mortgage amount is, combined to buy and start a zero down, tax-free rental business. And so in this situation, we're going to assume a couple of things. Number one, we're going to assume, come on. We're going to assume that they both qualify for $250,000 of a mortgage. Number two, we're going to assume that both veterans have a 30% service-connected rating. Therefore, combined, they are getting $1,074.84 in tax-free income. We're going to assume that this is a 6% interest rate. We're going to assume that they're putting zero down, and they don't have to, but in this instance they are. And we're going to assume that the property, this is an actual property for sale, is at 1906 Barrack Lane, and the listing price is $419,900. There we go. Had my background blurred, didn't even know it. Anyways, so the two veterans partner together and they purchase this fourplex, and they live in one unit and they rent out the other three. So at $419,900 purchase at zero down, your mortgage payment is going to be $3,349 a month. Now, you're going to probably end up getting about $1,000 a unit currently in the Bryan area for the other three units. So that means that you're bringing in $3,000 a month of rental income, leaving you with an effective mortgage payment of about $349 a month. Pretty good. But then when we factor in that tax-free service-connected rating payment, you have effectively, you're in the green, $726 a month. So what you're doing here, what this partnership is doing, is they're taking other people's money, they're paying down a mortgage, and then they're using the rest of it, they're using their tax-free income to pay for the rest. So I don't know about anybody else, but using other people's money and tax-free income to build wealth is a pretty awesome thing. So what you would do with that extra $726 a month is just kind of, put it into an account. You need to have some type of liquid reserves when you are renting out property, just because stuff happens. So I would recommend doing that. And at this point, you're going to want to track your income, you're going to want to track your expenses, and you want to set up that separate account and kind of start treating this as a business. The one thing you don't want to do is transfer the ownership to a business entity. And the reason why you don't want to do that, you can eventually, we'll talk about that here in a minute. The reason why you don't want to do that is because if you do, and the mortgage, let's say your mortgage company issues a property tax payment because you're escrowing all of this, and they issue it to the property under your name, and then the county kicks it back because you have transferred ownership to a business entity, they're going to come back and say, hey, you don't own this property anymore. You're not living in it. You promised that you were going to, this is going to be your primary residence, not a business. And they're going to make you pay that loan off in full. It is what it is. The VA loan in and of itself was never meant to be a way of buying rental property, but there are ways around it, obviously. So let's talk about how we can do that, though, because you do need to have some protection. You do want to have this be in an LLC or an S Corp or something like that. So through the power of appreciation, that $419,900 fourplex is now worth $510,873. So this is 5 years later, by the way. Same time, the principal on that mortgage is $390,735. Now, if you subtract the value minus the principal, you now have $120,138 of equity combined in this property. So that's pretty cool in and of itself. You just created $120,000 out of thin air and zero down in 5 years. But when you divide that by the new value of the home, you have 23.5% equity. Well, what can you do when you have 23.5% equity in a property? Well, you can refinance to a 20% down investment conventional loan, and then feel free to put that start that business entity and put that property in whatever entity you want, because you are no longer telling the federal government that you are that is you're living there, and then you can move out, you can do whatever you want. But long story short, wait about 5 years, build your equity, refinance, and then do that. So that is how to start the business, right? And in perpetuity, these two veterans, these two people, active duty service member, they are receiving this business income, and it's a pretty cool thing. They just created a business from zero down, right? And they can do this to multiple properties too. They don't have to just do it to one. In this instance, we are doing it to one, but through bonus entitlement, you actually can do this multiple times. But that's probably a video or a topic for another video. So let's talk about how we can make all this stuff tax-free, because that is what I promised y'all, right? Okay, so because you are now, these two VA buyers are operating a rental business, so 75% of this property is a rental business, the other 3 units, right? So you have access to depreciation, expense deductions, and a little thing called the home office deduction. And there's plenty of other deductions out there. I recommend a book called Tax-Free Wealth by Tom Wheelwright, and it breaks everything down much better than I can. And in fact, obviously, I recommend talking to your CPA for any and all of this stuff, because we're just going to get a general idea about it. So again, so let's start with depreciation. So if you have a rental business, you are allowed to use depreciation. And what standard depreciation is, and there's a lot of other different ways to do it, is you take the total price, the total value of the property minus the land, and you divide it by 27.5 years. And you're allowed to take that deduction on the income from that business every year. And so what that looks like on this property, the property minus the land is worth, 75% of the property minus the land is worth $270,000. The reason why you go 75% is because, again, you're living in one unit and the other 3 are rentals. So when you do that math, you now have $9,818 of a tax deduction that you can use to offset your tax payment that you would normally have on that rental income. Another thing you can do is deduct all of your expenses. And the cool thing about this is, normally if you itemize expenses, you're always allowed to deduct interest on your primary home. But if you itemize like that, you don't have access to the standard deduction. With a rental property, you can use both depreciation, expense deductions, and the home office deduction, which we'll talk about, and still have your standard deduction for your everyday job. So property taxes, again, 75% is about $5,900. Insurance, 75% is about $1,800, and your interest that you pay in the first year is right around $18,000. So all those combined, you're looking at another $26,487 of deductible income. So we're already pretty much over the amount of income that we have from the rental business already, but there's more. Basically, without making it too complicated, the home office deduction will get you about another $1,500 in deduction. So we start off right here with $36,000 of rental income from the other 3 units. $3,000 a month times 12 is $36,000. We're subtracting our depreciation, we're subtracting our expenses, and we're even subtracting that $1,500 home office deduction. We have actually a negative taxable balance of $1,805. So what that looks like is, because you are now a business owner, you are now renting this property out, you can say that you do X amount of hours of business. You can now carry that loss over. You can't deduct anything further because you only have $36,000 to deduct, but you can carry that loss over to the next year. And yeah, that right there is how you can make all the rental income from that zero down fourplex that you turn into a business tax-free. And you can, and again, we're using tax-free income to cover a portion of the mortgage as well. So basically, you are using other people's tax-free money and your own tax-free money to build wealth. I don't know about y'all, but I think that's a pretty awesome thing. So that's it for today's episode. If y'all have any questions, feel free to reach out. And yeah, appreciate y'all watching. And sorry it wasn't live, but see y'all next time.